All right, let's dive into the latest from UniFirst Corporation. Their new quarterly report is, well, it's a bit of a head-scratcher. You've got a story of growth on one hand, but when you look a little closer, you see this classic battle happening between their sales and their profits. So let's break it all down. And boom, right here, this is the main event of the whole quarter. You can see it clear as day. The company's sales, they're chugging along just fine, nice and steady. But their profits? Whoa, they're heading south. And you better believe that this split, this divergence, is what Wall Street really honed in on. And let's just say they were not impressed. So what happened next? Well, the market's reaction was pretty brutal, and it was fast. The moment the opening bell rang after that earnings call, the stock just tanked, dropping a whopping 7.5%. I mean, that's a huge signal, right? It tells you investors basically ignored the sales numbers and went straight for the jugular on that profit miss. Okay, so let's get into the nitty-gritty numbers that caused all that drama. This is really a classic case study, you know? A little bit of good news on revenue getting completely steamrolled by some bad news on the earnings front. So check this out, because the scale of the difference is what really matters here. On the revenue side, they brought in $621.3 million. That's a beat, sure, but only by about $1.5 million. Kinda meh. But then you look at the earnings per share, the all-important EPS. They posted $1.89. The street was looking for $2.10. That's a miss of 21 cents. And trust me, in this game, that 21-cent miss is way, way bigger than the $1.5 million beat. Okay, so why did they miss on earnings? The answer is all about the margins. This is where the story really gets interesting. Their operating margin dropped to just 7.3%. Now, compare that to last year, when it was 9.2%. That's a pretty steep drop, 190 basis points to be exact. To put that in simple terms, for every single dollar they make in sales, they're now keeping almost 2 cents less in profit. So even though they're selling more stuff, rising costs are just chewing up their profits. So the big question is, what's putting the squeeze on those margins? Well, according to management, this wasn't some big surprise. They're basically saying it's a mix of costs they planned for and some others that were just, well, unavoidable. They laid it out pretty clearly, pointing to 3 main culprits. First up, they're intentionally pumping more money into their sales and service teams. You know, spending money to make money down the line. Second, they got hit with some higher healthcare and legal costs. That stuff can pop up. And third, they're still pouring cash into this huge internal tech project, something they're calling their key initiative. And this quote from the CEO, Stephen Crow, really says it all. He's trying to spin this whole thing, right? He's framing these costs not as a problem, but as part of a grand strategy. He's telling Wall Street, hey, calm down. This is all on purpose. We're investing now so we can grow faster and become way more efficient later on. He's playing the long game here. So let's zero in on that key initiative for a second, because it's a really big deal. We're talking about a massive multi-year overhaul of their entire company software. Just this quarter, they spent about $2.3 million on it. Now get this. That spend alone knocked 9 cents off their earnings per share. Do the math. That's almost half of their entire earnings miss, all from this one single project. Wow. All right, but here's the plot twist. While everyone's busy dissecting margins and tech spending, there's this huge elephant in the room, a massive external factor that, frankly, overshadows everything else. Their biggest rival, Cintas, has made an unsolicited offer to just buy the whole company. And yeah, that changes the entire conversation. And we're not talking chump change here. The number Cintas put on the table is $275 per share, all cash. Now, this isn't just some rumor floating around. It's a real, formal proposal that the board now has to seriously consider. The pressure is on. So just to put that $275 offer into perspective, let's look at where the stock is actually trading. It's hovering around $197. So Cintas is offering a huge premium over the current market price. This creates this really interesting dilemma for investors, right? Do you stick around and bet on UniFirst's long-term comeback story, or do you root for the quick and easy payday from a buyout? It's a tough call. Okay, so let's tie this all together. You've got these weak margins, these so-called strategic investments, and then this monster buyout offer hanging over everything. What does it all mean? Well, here's our take on what happens next and what our final rating is. So here's our 3-step forecast. First, the prediction. Don't expect these margin problems to magically disappear. Management itself is pointing to fiscal 27 as their big pivot year. That's a long way away, so expect costs to stay high for a while. Second, price action. Because the fundamentals are kind of messy right now, the stock isn't going to trade on earnings. It's going to trade on news about the Cintas deal. Every rumor, every headline is going to move the needle. And that leads us to our final rating. We're calling this one a market perform, and here's the thinking behind that. On one side, you have all those operational issues and heavy spending that's going to put a lid on how high the stock can go based on its own performance. But on the other side, you've got that $275 offer from Cintas acting as a safety net. It creates this really strong floor, you know? It's hard to see the stock falling off a cliff with that offer on the table. So it's basically stuck in the middle. So this brings us to a potential trade idea. And this is interesting. With the stock trading so far below that offer price, you could think about selling cash-secured puts. Now, what does that mean? It's basically a bet that the Cintas offer will keep the stock from dropping too much. You're betting on that price floor we talked about, and you get paid a premium just for making that bet. But, and this is the big but, please remember this is not in any way financial advice. You've got to do your own homework.